Hey guys, it's Mike Barnes, the financial first responder. Hey, if you haven't had a chance to do this, please like and subscribe my channel. Listen, we've been talking the past couple of weeks, a couple of days, based off of personal credit. And a lot of you don't know this, but for years I've helped small business owners, veteran business owners with business credit. So I wanted to talk to you briefly about some things that I see that I think you need to be aware about. This is for educational purposes only. I am a licensed financial professional, and I look forward to helping you if you decide to go into business, start out on the right foot. So without further ado, let's get started. So the financial first responder wants you to figure out the right way to use business credit. There's a lot of gurus out here that talk to you about business credit, and they tell you, go get this card, get that card. The bottom line is you got to build it, protect it, and then leverage without destroying your personal credit. So with that said, I got some slides that I think might be beneficial to you. Stay in there, watch till the end, and you may be surprised on what you did or did not know. Let's go. So, the almighty dollar. Some of you have graduated to having great personal credit, but now you're embarking on this business. And what we don't want you to do is get shackled through financial slavery to some debt. So, let's talk about this for a second. What we want you to do is we want you to ask yourself what business credit is and what it is not. Who tracks your business credit, whether it be Equifax, Experian, TransUnion, and of course, LexisNexis. The FICO scores versus the business credit scores, because they are different. And the step-by-step business credit building system that I'm going to give you some examples for. And then we're going to talk about some pros and some cons and a protection strategy. And then we'll give you some real life scenarios for small businesses. Is that cool with you? All right, let's go. Now, most business owners have this in common. We got a lot of files and a lot of stuff going on, but we need to know the basis between personal credit and business credit. See, personal credit, that's you. That's the use of your social security number. That's your personal credit file. That's that FICO score, 300 to 850. And often, it could lead to you having to be a personal guarantee early on when you start a business. But see, business credit, that's your company. That's that EIN number that you get from the IRS. That's that business credit file. That's that business scores vary by bureau and model because they all judge differently. And then the goal is to get approvals without relying on your personal credit. I say that again. Our goal is to help you get business credit without relying on your personal credit. Now understand, when you're first starting out and you're not making a lot of revenue, your personal credit has a lot to do with who will loan you money on a business credit. So what we're talking about is we're talking about the 4 key data sources that you need to know. Now, we talked about Equifax. We've talked about Experian. We talked about TransUnion. We talked about LexisNexis. But did you know that they can actually affect your future business credit? You see, Equifax, if we talk about the business, they look at your payment behavior, your public record, your credit exposure. Experian, they look at your IntelliScore, which is usually 1 to 100, and then they look at any risk indicators. TransUnion, they look at business risk models, and then your utilization, and then payment trends, and then LexisNexis, it identifies all of your information. So it verifies who you are. It looks at any risk data that's used by banks and insurers. See, the key point I want you to think about here, people, is this, is that you can be denied before a credit score is even check or pull. They do soft pulls. So what we want to make sure is we want to make sure that whatever you do, you have the things in place to get started. So let's look at that. So we talk about LexisNexis. It's the gateway. I use some stairs here because I want you to understand there's levels to this. There's levels, levels, levels. So often what's used to verify your business identity and your legitimacy. Hey, look, I know there's people out there telling you just start an LLC and blah, 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 and da, 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 da. No, you need to be strategic with this. They check the consistency of your business data across a lot of sources. Do you have a website? Do you have email that's tied to the website? They look at whether you have a physical location or whether you're using a virtual location. And then here are some of the common denominators or denials that trigger a no. The first thing they want to look at is, do you have any mismatched address, phone numbers across filings, banks, and listings? See, a lot of times, people, what you do is you'll put down your cell phone number, and then you'll put down your home number, and then you'll put down your business number if you got one, or your Google number, or whatever voice over internet protocol number you have, and they don't match all of your filings or your licenses or your licensures. They look at the footprint. So it's a thin footprint or conflicting officer information. You got yourself as the CEO in one document, and then the next document you got yourself as the president, or you got yourself as the CFO, or you got yourself as the COO. You know, you have to be accurate in how you list this. And then they look at public records as far as risk flags. Now, I want you to think about this. There's action steps that I need you to keep in mind. You got to keep your name, your address, your phone number, and your officers consistent across all lines of communication. Anything dealing with the public. In other words, you can't look like you're committing fraud. Now, we talked about FICO scores and personal, but here's a quick breakdown again. I know some of y'all want to be on that private jet one day, including me. So that's why I have it up here. But we got to move fast like a jet. Your payment history, it needs to be on time all the time. It matters. 35% is what they look at. Utilization, they look at 30%. You got to keep these balances low. Length of credit. Your older accounts help. You know, you can't be a newbie at this. Mixed credit, 10%. Revolving plus installment loans. New credit, 10%. Not too many inquiries though. And then business truth. The early stage funding you have to think about is you're probably going to have to be a personal guarantee. A lot of people are like, I don't want my name on it. I'm like, well, you got to start somewhere. Now, as the financial first responder, we talk about business credit scoring. What matters most is those vendor payments, that behavior. We often say it rewards you to pay early. Now, you know, for some of you that remember the iconic Mustang, there's been multiple Mustangs over the years. I'm a Mustang owner myself, and I can tell you the body has changed, but not the name. Now, what do I mean by that? The body has changed, but not the name. The way that they look at businesses, it's a business, but the way that they look at it has changed over time, right? So business stability, age, industry risk, public records, they're looking at, you know, hey, have you been sued? Are you paying your bills? Blah, 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 right? Utilization, you want to keep it low. Number of active trade lines. Now, we're going to get in that in a second, but I want you to understand quality versus quantity. And then score, often the use of the score is usually from 1 to 100 or similar risk scales. It varies by whatever model that they're using or the business use a model to design your business credit. Now, let's talk about the right way to build business credit. It's a ladder. Now, I know in this example, it looks like I'm talking about a maze, but a ladder can be defined in multiple different ways. Okay, a ladder is usually linked, right? So, step one, build the foundation. the entity that you use, the EIN, the bank account, the consistency. Step 2, and I'm reading this verbatim, so you can't say the financial first responder didn't explain this to me. Step 2, start with a vendor that has terms of net 30 or net 60, and we'll go over that in a few minutes. That report, that helps you build your credit fast. Step 3, pay early to improve your business scores. Step 4, add store and fleet cards, higher limits, easier approvals. As an example, I'm not promoting them, but it does help. Uline, if you can see this, Uline is a great place that you can actually get new business credit. Okay. Then you want to do step 5, graduate to your business cards and lines of credit. That is when you've got some experience. And then step 6, reduce your personal guarantee dependencies over time. Business stands on its own, meaning you're making some money. Now, a lot of you are saying, well, wait a minute, Mr. Financial First Responder, you've been a little bit too deep today. I just started my company, and the first thing I ask you is how do you make money? Because it matters. Don't borrow if you can't pay it back. So in my first example, we're talking about a vendor and getting credit of net 30 done correctly. This is what it may look like. You have a new LLC, you open up a net 30, which means you pay all your bills within 30 days, okay? And they provide you, or they allow you to have credit of $200 per month for supplies, right? You pay the invoice in 10 days, usually earlier than later, instead of waiting the whole 30 days. The result is this: you're going to get a positive trade line on your business credit. It builds credibility and it improves your risk score. Rules: never pay vendors late. Never pay them late. If you got to call them and say, hey, I can pay you $1 today, I can pay you $2 tomorrow, I can pay you $3 the next day, pay them, pay them, pay them. Reporting spreads fast between vendors. Example 2, utilization. Use limits without looking risky. Now, what do we mean by that? You get a business card limit. Let's say it's American Express. If you decide to carry a balance of $8,500 on that American Express, you are utilizing too much of your credit. That is a risk. It's better to keep your statement balance below $3,000 because that's 30% of the card. Best bet is make mid-cycle payments to keep reporting balances low. Now, you may say, well, wait a minute, Mr. Financial First Responder, how am I going to do that? Well, if you had the balance that we're talking about, the $8,500, maybe you pay $1,500 this week, and next week you pay another $1,500. Now you're at $3,000. If you pay an additional $1,500 and another $1,500, you're at $6,000 by the end of the month. So effectively, you only have $4,000 on that card. So maybe you pay $2,000 one day or 1 week, you pay $2,000 the next, and then you do $1,500, and now you're at 30%. Okay. Now I want you to think about it. For you to do that, you have to be conscious of how much credit you're using, right? Example 3, reducing personal guarantees. Now, see, in the early times of your business, the personal guarantee might be required because the business file is thin, meaning you don't have any experience. 3 to 5 months of reporting a trade line keeps utilization low. That helps. And then you correct this by taking that use of the personal guarantee as a bridge, but not as a permanent clutch. In other words, you want to wean yourself off. And then after 12 months to 24 months, you got clean history. And then you can pursue options with limited or weak personal guarantee reliance. In other words, they will take you off if you can show that you've been paying. Now we're going to beat our drums a little bit. We're going to talk about pros and cons here. That's why I'm saying we're doing some drum beating. The pros, when used correctly, this is what's going to happen. It protects personal credit and assets. It improves cash flow, especially your terms and your lines of credit. You get higher limits as the business grows. Your better vendor relationships and credibility with the people you work with. You get support. It supports scaling, meaning you can grow your inventory. You can buy more equipment. You can hire people. Cons. Here's the risk. If you misuse it, this is what's going to happen. You're going to over leverage and crush your cash flow. You're going to have late vendor payments that can block your future terms. You're going to end up staying as a personal guarantee, often which was required when you first started. You're going to have public record hits of hard. Mixing personal and business creates tax and legal issues. Now, I can't tell you how many times people mix their personal and their business to pay for expenses because they don't have enough business credit. Stop it. Work your way towards using business credit only. Personal credit is for personal, meaning you. Business credit is for your entity. It's okay, you start out like that in the beginning, but not when you've been in business 10 or 15 years. Protection and monitoring. We suggest you do this quarterly. Quarterly, if we had a checklist, I'm just saying, if we had one, we'd review the business reports when available or where available. We'd run an audit to identify any name or address or phone inconsistencies, because you want to be consistent with this. We would dispute any errors on our business credit as fast as possible. We would consider freezing and restricting access where appropriate, including LexisNexis, and then we'd set up internal rules for applications, spending limits, and approvals. Now, for some of you who have employees, you might want to do this. This is a fraud hack that I'm going to tell you to prevent you from being duped or your money being stolen. If the same person signs your payroll checks that pays your bills, you're wrong. If the person who has access to your checking account and can write checks on that account and pay bills on your behalf is the same person, you're wrong. So what I'm saying to you in essence is you should have at least two people looking at these things. You know, if it's a husband and wife, obviously the wife may pay the bills, the husband may be a second signer. If you have a manager, maybe the manager gives you the bills and then you and your wife pay them. Or maybe you have a person who's just in payroll, they pay payroll, another person pays bills, and then you review everything on a consistent basis. I can't tell you the amount of times that people lose money to employees because they have no checks and balances. Look, this is the financial first responder. You ain't got to like what I'm saying to you, but you can best believe I want to keep you out of trouble with the I, the R, and the S, but I also want to keep you out of trouble with people that could potentially use your good faith and personality to do unscrupulous things. So here's a mini case. Here's a quick story. Let's say that you're a small contractor. And we said that you're going to pay your vendors early. You're going to keep your utilization under 30%. You're going to track all your cash flow. In the greatest of ideas, that would be the perfect situation. The outcome: equipment financing and bank lines of credit have better terms. But if you're a stress contractor, meaning that you maxed all your cards, pays your vendors late, mixed personal and business, the outcome is strictly this: denials. vendor freezes your credit, personal FICO score drops, and then you get higher rates because they punish you. Now, here's what I'm going to say to you. If what I said to you today makes sense and you see that it could be of some benefit to you or someone you love or someone you know, I want you to think about this. My name is Mike Barnes, the financial first responder. I am a licensed financial professional. I do provide business credit through some affiliations that I have. If you're interested in that, go to my website, True North Advisory LLC. Go into the ask a question or get a quote or anything like that, or on this YouTube channel, click and say, hey, that's me. Can we talk? We'll set up a virtual appointment. We'll sit down and we'll look at all the facts. We'll lay them out. We'll look at what you're trying to do or what you are going to do, because we don't try, we do, right? That's what Yoda said. And then let's come up with a plan. I keep talking to you about this financial positioning system. It helps business owners. It helps families. It helps individuals. It helps people who are willing to change their financial habits. So with that said, this is Mike Barnes, the financial first responder. Please like and subscribe my channel. Click the link below to get started, and I will see you on the beaches of the world. God bless.